the corporate finance class. Today we're talking about raising capital. How do firms finance its investments? We first talk about some early stage financing and the concept and use of venture capital. Then we talk about some selling securities to the public, which is the IPO, initial public offering. Then we talk about some alternative issue method, the underwriters, underpricing of the IPOs, new equity sales and the value of the firm, the costs of issuing securities, rights offering, and dilution. Venture capital. We talked about venture capital in the very first class when we talked about the overview of the financial world. The venture capital, they are a kind of PE, private equities, but it's a special private equity that invests in the early stage of startup firm. Suppose you're a very talented young man or young woman. You have an excellent idea, and you know that this idea, if it can realize, will bring a lot of fortune and wealth to the world. For example, you have a technology that can convert the water into oil, for example. Well, we know that's almost impossible, but kind of like very magical technology. You're talented, but you need money. You need assistance. You need to register a corporation. But you don't know how to do it. You're just a technician. You're an engineer. You know the technology, but you don't know how to do the business. Then the venture capitalists will find you. They will say, hey, young man, you're talented, and we are very interested in your technology. We don't know how to do it. You know how to do it, but you don't have money. So we give you money. We estimate that the initial investment into the equipment, development of the technology, and all the other costs, about like $10 million. Maybe $5 million, $10 million is a bit too much. $5 million. But why do the venture capitalists want to give you money? Because they want something back. The ownership of your technology. Or rigorously speaking, the ownership of the firm that owns this technology. So they, the venture capitalists, and you cooperate to fund a company. And you two are both the owners of this company. And this company received the money from the venture capitalists. And they receive your effort to develop this technology. For example, the venture capitalists give you $5 million for about 20% of the stake. So the venture capitalists have 20% of the stocks of this company, and you have 80%. You, the idea generator, the technology owner, you are called a general partner or GP. You are a general partner because you are the main person responsible of developing this company. And the venture capitalists who gave you $5 million for 20% of the stocks are called limited partners or LPs. The company should have an exit strategy. That is the exit strategy for the limited partners, for the venture capitalists. They either sell the company to some other companies. For example, they sell your company to Google, to Amazon, to some larger, maybe to some banks if you are a fintech company, or they take the company public. That is, they want to sell the stocks that they have invested in you for the stock. They want to sell these stocks to the public. There is a difference between selling the stocks privately and selling the stock to public. When you want to sell the stocks to the private investors, you just find these investors in private and negotiate with them the price privately. For example, they say like, hey, I have 20% of this company's stocks, and I invested $5 million. Now the company is becoming bigger and very promising. So how about, do you wanna buy 20% of this company's stocks for say 50 million? Or if you don't want to buy this much, do you want to buy 5% for 15 million or 10 million? Something like this. Or you can sell these company stocks to public. That is initial public offering or IPO. Through a regulated procedure, you sell this company stocks to the people that you don't know in person. The other investors, maybe hedge funds, maybe mutual funds, maybe retail investors, they can buy or invest into the stocks of this company. And in that, we say this company is going listed. And this company will be called a publicly listed company after IPO. Many VC firms are formed from a group of investors that pour capital and then have partners in the firm decide which companies will receive financing. So they have a group of investors pouring money into a firm, and that firm is called a VC, venture capital. And this VC funds, they have the fund managers. They receive the proposals from a lot of talented people, or the people who think they're talented. And they will give the BP to the VCs, business proposals. The BP may say, I have this idea, I have this technology, and this is my CV. I'm a scientist, I have a lot of patents before. And why this feasible, why not only the technology is feasible, it's also profitable. The potential market, these people may want to buy my product, and that people may want to buy my product, and how many companies may be willing to purchase our technology so that we can sell this company to the other companies, something like this. And the VC firms, on average, they receive several hundred. Well, some successful VC firms may receive thousands of different business proposals every day. So they need to spend a lot of time but they are very experienced when they just read the proposals and find like, okay, this idea is very cliche. It's very old. No, it doesn't. It's not going to make money. Okay, this is a good idea, but this person is not a good person to conduct this business. Then they will finally select a group of founders, potential founders, for an interview. And when they're happy with the idea and the person and the negotiated details of the investment contract, for example, how much money to invest in for how many percentages of the stocks, then they will sign the contract for the investment and form a company. Some large corporations have a VC division. For example, China's Tencent, Alibaba, the US, Google, Amazon, they all have VC divisions to invest in small companies that may generate or produce the technology or product that they want. Okay. Choosing a venture capitalist. The venture capitalists give you money, but you want to cooperate with them, not only for the money. Because any venture capitalist, if they want to invest in your company, if your company is very promising, you will receive the money. So you want something else. For example, you may want to look for the financial strengths. Does this venture capitalist have a lot of connections in the banking industry? Do they know a lot of people who have a lot of money, so that when my company is in 5 years, if we develop and need more money, or if we unfortunately encounter a financial crisis, will they have enough connections and resources to finance us? You probably are asking yourself, are they famous enough? Do they have a lot of media friends who can help advertise our products? And we're technicians. Do they have very good management skills? Is it possible for them to help us hire a good COO? If we need some other people like chief marketing officer, do they have enough knowns, the friends, so that they can help us? So you want to consider a lot of factors to finally make the decision to be invested by a venture capitalist. Again, it's like a marriage. Okay, you want to choose a venture capitalist, and the venture, just like the venture capitalist wants to choose you, because they want to find the good projects to make their money appreciate, to make their investment go up in value. You want to find someone with good resources to help you grow. Selling securities to the public. Besides selling this whole company to another bigger company or a corporation group, you can sell the securities to the public, to the strangers, to the people you don't know. There is a regulated procedure to do this. The management must obtain permission from the board of directors. If you still remember the things that we talked about in the very first class, in the second class, the shareholders elect a board of directors, and these directors will elect a chairman of the board, and the chairman of the board will call the board of directors meetings, and these people represent the shareholders because they are the largest shareholders usually, and they hire the management. So they're the owners, and the management teams, like the CEO, COO, CSO, CMO, CIO, they are the executives. The executives are those people who do things, but they do things, before they do things, they must obtain the permission from the owners. So once the board of directors permit, they say, hey, they approve the management to sell, to make the decision to make the company go listed, to sell securities to the public. Then the management will file a registration statement with the SEC. SEC is the U.S. Security Exchange Commission, who's in charge of supervising the IPO process and the stock market. In other countries, there are some equivalent institutions. The SEC examines the registration during a 20-day waiting period. And during the 20-day waiting period, a preliminary prospectus, also called a red herring, is distributed during this period. What is a prospectus? A prospectus is a very thick book. It's like 400 pages, 500 pages, prepared by the underwriters. The underwriters are investment banks. We also talked about in the very first video, the very first class. The underwriters will do a lot of due diligence. That is to provide very detailed information about this firm. Because this firm is like an asset. It's like a real asset. And the underwriters want to convert it into a financial asset by designing the stocks. Stocks are basically the financial contract saying that you have the ownership of these real assets. So they want to evaluate the real value of the real assets. So they provide a lot of details. For example, how many factories does this company have? Do they claim that they have like 50 factories? Do they really have the 50 factories? In the due diligence, the underwriters or the investment bankers, that usually a lot of them just graduated from Ivy League or very top schools. Other people, some of you, the business school students, after you graduate, you will become investment bankers, and this is your job. Your job is to go to the somewhere like this company claims they have the factory. You want to go there and take a photo and video and say, hey, this is really their factory. They claim that this factory is making shoes. You go in there and you say, hey, there are some equipments really are making shoes. You want to do some interview around the neighborhood, and you want to interview the workers working in these factories to make sure that these equipments were not borrowed. In some financial fraud, the company just asks people to borrow some equipment and put some actors there to pretend that they have the factory, but actually they don't own this factory. After the company goes listed, they just return this to other people, because the factory, these people, this equipment, they're all assets. They want to pretend that these assets are theirs, but actually they're not theirs. You also want to check the invoices, when and where they purchased the equipments, and you want to check the labor contract, and you want to make sure that these people, these workers, are not actors. They're really the employees. You want to call the equipment suppliers to make sure that, hey, they really purchased this equipment from you. It's not a fraud. It's not the whole contract and the invoices are not just fraudulent ones and not fake ones. So you do a lot of things. These are called due diligence work. It includes a lot of things. This is just factories. You also want to go to their markets. For example, they claim that the company claimed that they sell their products in 130 countries. You always see companies claiming that. So you really want to go there. You want to interview the chief marketing officer. You want to call or even visit the countries and find that they really sell the products there. You want to verify the information, reduce the information asymmetry to make sure that your investors are investing in the valuable assets. So all of this information are in the prospectus. Funny thing is that they even question the CEO and the management team. They question like, do you have the mysteries? Do you have some children that other people don't know? They even ask these embarrassing questions because these things matter for the corporation's reputation in the future. These things matter about the company's risk. Okay, these are idiosyncratic risks. So they want to know all of this information, and they include all this information in the prospectus. From the prospectus, the investors, after reading them, they will know all the information of this company. If there were problems, the company is allowed to amend the registration and the waiting period starts over. Why? Are there some problems? The underwriters, they prepare the prospectus, just like the researchers write academic papers. The SEC people, they are like the referees. So they check your prospectus. They want to know if there's anything suspicious about this company. For example, you say, wow, this company sells this many products. But then in the other table, I find that the profit seems not match the number of products that they sell. And then they say, hey, they claim that they have this many employees. But then I check the Social Securities expense. I just find that they don't match. So they check the very details in the prospectus. And there will be a interview-like Q&A session. And the underwriters were very nervous. They're always very nervous about this in this occasion. If they answer any questions wrong or make the SEC officials unsatisfied, the company may not go listed. This whole procedure is to protect the potential investors. The securities may not be sold during the waiting period. The price is determined on the effective date of the registration. Okay. And this is IPO. After going through the IPO, the company can proudly call itself a listed company. The whole procedure involves a lot of expenditures. For example, the underwriters visit all of your factories, your customers, and prepare all of this. They need to be paid. Who pays this? The company that is going listed. Even though they fail to go listed in the end, they still need to pay these underwriters. And this is called a commission fee. Okay, when they pay the underwriters, they cover all the travel expense, and they pay a commission fee of about 7% of the final capital raised. When you sell the stocks to the public, you are actually receiving money from the public because they're selling your ownership for money. And these money are called the capital raised from the IPO. In North America, you need to give 7% of these capital raised to the underwriters. In Asian markets, it's much lower. It's about it varies across areas, but much lower. Sometimes like 2% even. Crowdfunding. Crowdfunding is a similar but also very different process than IPOs. In IPOs, you sell your stocks to the strangers. In crowdfunding, you are also selling your products to the strangers. Remember, in crowdfunding, usually, at least in the US, you do not sell your stocks, but sometimes you sell your stocks in other countries or under some special situation. The crowdfunding doesn't go through the regulations, the regulator's supervision. But in IPOs, before you sell all of your stocks, or even bonds, you have to go through the SEC's supervision and questions. There is no underwriter usually in the crowdfunding, and crowdfunding is usually conducted via internet. So basically, crowdfunding is a practice of raising very small amounts of capital. Maybe it's $50, even $5, $1. Okay, no more than $1,000 from a large number of people. It's a very famous website. It's called Kickstarter, if you know, or Artist Share. So the Artist Share and Kickstarter, when you have a project and you want to know whether other people want to buy your products because the producing them is costly. So you first make a video and say, hey, I have an idea. And if I make my products, it's going to be like this. And I've already probably made one. If you want to buy them, you can just give me money. And after I receive your money, I will buy. I will keep producing this one. And if you have any questions or suggestions, we welcome your feedback. This is also a financing. to finance your future investments. To make one product, you only need, like some work. But to produce, say, 1,000 products, 1 million products, you probably want to build a factory. But building a factory is very costly. Traditionally, you build the factories, produce the products, then sell. In crowdfunding, you first sell, then you produce. You invest, then produce. So this is also a method of raising money. So it was first used to underwrite the U.S. tour of the British rock bands, Marillion. So, like, the rock band wanted to say, hey, I want to go to the U.S. for a tour, and how many people want to pay us and listen to our music? So you first pay for the music, for the tickets. Then they receive the money, then they go. Otherwise, they don't have money to go for a tour. There were different methods for issuing new securities. Issuing the securities can be public or in private. There was some traditional negotiated cash offer, and we will detail that later. The firm commitment cash offer, the best efforts cash offer, and Dutch auction cash offer. So these are the offers and or contracts between the issuers are the companies who want to issue or want to sell their securities, sell their stocks. The issuers and the underwriters, the investment banks. The firm commitment cash offer is saying, is a contract saying that the investment bank or the underwriter promises to sell this amount or this value of shares. If there are not enough potential buyers, the underwriter itself, this investment bank, will use its own money to buy these shares, to make sure, to ensure the firm owners that their shares will be sold. Okay. The best efforts cash offer is like, we set the price together first, the price of each stock. And we do our best to sell as many as possible, but we are not really sure. Even though we do not finally sell all of the stocks, you have to pay the flotation costs. Flotation costs are like the insurance costs or the underwriting, all of these the fees. We will talk about the Dutch auction a little bit later because it's a little bit complicated. There are also some other methods. One is called a privileged subscription. Okay, so you can offer, the company can offer the new stocks to its existing shareholders. Okay. And there are some non-traditional cash offers, like shelf cash offer. It says that qualifying companies, they can just authorize the shares they expected to sell over, not just now, but over, in traditional IPO, you have to sell all of your shares in the first day of the IPO. But here you can, for the shelf cash offer, you can put these shares here for 2 years. During the 2-year period, you can sell them when you need to sell them. When anyone want to buy them, you can buy them over the 2-year period. There is also a competitive firm cash offer. The company can elect to award the underwriting contract through a public auction instead of negotiation. So we don't have to negotiate the price and how many shares to sell. We can just make a public auction. There is a private issuing method called direct placement. that is the private negotiation, not to the public, but to private investors. You negotiate with private investors. Hey, this is 20% of the stocks of a company. Do you want to buy them? How much do you want to pay this? Basically, the negotiation, the bargain process, according to a senior investment banker who's my friend, is not too much different from bargaining for some ice cream from a grocery store. It's basically like, hey, do you want to pay this much? Do you want to pay that much? How much do you want to buy? Like something like this. So we talked a little bit about the underwriter. There were more. The underwriters formulate method used to issue securities. They price the securities. They first investigate all of the company's business operation assets. Then they use they evaluate the value of the real asset divided by the total amount of the shares. Then they price the share price. Also, they take into account many other factors. For example, the growth factors and like the goodwill and the brand, these intangible assets. Like how do you price the company's reputation? There are two companies; they're the same, producing the similar products, and their sales are similar. But one company is, well, this is 2020, so I can say one company is Tesla, and the other company is BYD. Okay, so at least as of 2020, BYD's brand sounds inferior than Tesla. I'm not sure. Like if you watch my video in 2025 or 2030, I'm not sure if the things will change. Okay, I would be very happy if you leave the comments under this video if things change. So the underwriters also help with selling the securities. After they price the securities, they create the securities contract. They are creating a financial asset, and they want to find the buyers for this financial asset. They will make a list of all the potential investors, and they just make calls and say, "Hey, we have a very good company's asset, and do you want to buy?" And then they will make a roadshow. Okay, a roadshow is like a presentation. They invite the CEOs and the management teams of this company. Then they give them a presentation. Sometimes they have the luxury lunch. I've been there, and I was given because investment banker friend just took me there, and I had the prospectus, very thick book, and actually, obviously, everyone just it's just too many pages. They don't read this very carefully, and but we were enjoying the very good lunch and listening to their presentation. The underwriters are very good speakers. It was a company of a bus maker in Malaysia, so it was in Hong Kong, and the CEO wasn't that very good at talking, so the underwriter talked much instead of him. And then the main idea of the whole roadshow is to say, this is a good company, buy the stocks, please buy the stocks. If you think like everyone is really, the people who are sitting there for lunch are discussing the stock price, or you're wrong. They talk about the very random things. Probably they have their analysts evaluating the stock price and decide whether to buy this or not. So the underwriters, they help the issuers to look for the buyers. And in this process, actually, the underwriters they really play a very important role. Because you know that the underwriter is a middleman. Okay, that's why it's called a broker-dealer. Okay, it's a middleman. From the view of the issuers, do you want your stocks to be priced higher or lower? Obviously higher, because the stocks are your assets. So you want to price it as high as possible because you want to raise more money. But from the point of view of potential investors, you want the price to be lower. And the underwriters, they want to persuade the potential buyers, saying, hey, if you buy this company's stock, very large probability that the value will increase, maybe 5% or 10% in the first day of IPO. Please buy it. What if the price dropped after the first day of IPO? And it keeps dropping. What will happen? The investors will be very angry at this underwriter. It's like you are a seller of a product, and your products, the buyer of your products, find that the products are becoming cheaper and cheaper. So they become very angry. And in the future, if you want to sell other company stocks, other products, and they will call them again, nobody's going to take your call. So the underwriter, this role is very important. You want to price the securities high enough to make the issuers happy, and not too high to make the buyers happy. Okay? And you want to stabilize the price by the lead underwriter. The lead underwriter, so in a syndication, if you have a group of investment banks, sometimes like a company have too many stocks, like Alibaba. One investment bank doesn't have enough potential buyers and clients to buy all the stocks. So they call the other investment banks together, form a syndication. It's called a syndication. And the investment bank who calls for the syndication is called a lead underwriter. The lead underwriter is the one who wants to stabilize the price in the first day of IPO. Because, let's think about it. On the first day of IPO, the stock price goes up a lot. Who's going to be happy? The buyers of these stocks. They will be happy. But who's going to be unhappy? The issuers. The issuers say, our market value could be 50 million. And our stock price could be 50. And you asked us to price it at 30. We lost like $20 million. Come on. And they will be very unhappy. If they are very unhappy, they're going to tell their friends who are also the owners of the other companies. Then you will lose your potential customers in the future. If the stock price doesn't go up but dropped, your buyers' friends, the investors' friends will be very unhappy. So you want to stabilize the price in the middle to make it go up a little bit, like 5% in the first day, but not too much. Okay, that's the job of the lead underwriter. We will detail this a little bit later. And also, there were some very funny things in that. I'm not gonna talk about this in detail, but if you Google the news, you will know what happened. Some funny things in the Chinese stock market, mainland Chinese stock market, like several years ago, during a roadshow. We said like roadshow is like a presentation for the underwriters to sell to market the stocks to the potential buyers. In a roadshow, the underwriter, kept talking about the stocks and say, hey, this stock is really good, you should buy it. And then there was a mutual fund manager in the audience just say, he said, "How dare you to sell us such a garbage stock?" And then the presenter, the underwriter, said something that really annoyed the mutual fund manager. He said, he said something very impolitely. He said, "Well, some garbage people like you can be the manager. Why can't I sell such a stock?" Now, you know what happened? They fought at the roadshow. They really fought together. So someone just punched the other face. Then on that day, after that day, I mean, it's the next day or on that day, I don't quite remember clearly, but the investment banks stocks on the market dropped a lot, like 9%. People say because the bankers punches mutual fund managers, and all the mutual fund managers are very angry about that, so they sell the investment banks stocks. So if you Google that, if you just or search Baidu, you will find this news. Happened several years ago. It's very interesting. Okay, so all of these are humans. They're human beings. They have their feelings, and it's just about the negotiation process of the business and marketing process. Anyway, so especially in the firm commitments sales insurance method, there is a difference between what the investment banks, the difference between the price that the investment banks get from the company and the price that the investment banks sell to the investors. What does this mean? Suppose that the companies, the issuer's stock price is set as $35, and then the syndication involving the group of investment banks like Goldman Sachs or Morgan Stanley, like these investment banks, they get the stock price at $35. But when they sell these stocks to the hedge funds, mutual fund, they sell it at 36 or 35.5. So they make a difference. That difference is called a spread. This is why they are called a dealer. A dealer is you get some product at a lower price and sell the same product at a higher price. The broker is connecting the potential buyers and sellers. This is why investment banks or underwriters are also called broker-dealers. Firm commitment underwriting. We talked a bit about this. It's a method that the underwriter makes money on the spread between the price paid to the issuer and the price received from the investors when the stock is sold. And the issuer sells entire issue to underwriting syndicate, and the underwriting syndicate then resells the issue to the public. So they commit the investment banks, the underwriters, they commit to sell all of these stocks for the firm. And it is the most common type of underwriting in the United States currently. Previously, there was a best efforts underwriting. That is, the company bears the risk of the issue not being sold. So we agree upon a offering price. We agree that we are going to sell this stock at $35, and we just sell. We don't know how many we can sell. We can sell this, but as many as we could. And if we cannot sell all of the stocks we want to sell, that's it is what it is. Okay. So it's not as common as it previously was because it increases the risk of the issuing company. Dutch auction underwriting. So this is an interesting one. Google was the first large Dutch auction IPO. So during using the Dutch auction IPO, the underwriter accepts a series bids that includes number of shares and the price per share. And finally, they take the price that everyone pays is the highest price that will result in all shares being sold. So let's use the next, take a look at the example in the next slide. Whatever XYZ company wants to sell, say they want to sell 10 million shares. The underwriter will make an auction. Say, we start selling this company's stocks at $40. And how many shares will the investors want to buy? We find that there are no bids. No bids meaning that no one is really bidding to buy the shares, and no shares. Okay. Then they lower the price to 39, 38, 37. Still no one wants to buy the share. And then they lower the price to $36. Finally, there are two people, or two bids from two institutions or buyers. Each bid is 500,000 shares. So in total, they want to buy 1 million shares. But XYZ company wants to sell 10 million shares. So they keep lowering their price to $35. At $35, besides the previous two people, there were four more people bidding for the shares. And in total, they want to buy 4 million shares. Then in total, plus the previous 1 million shares, in total there are 6 people who want to buy 5 million shares. But still, XYZ company, what they want to buy, they want to sell 10 million shares. So they keep lowering the price to $34. At $34, there were 10 more people who want to buy the shares, and in total, they want to buy 5 million shares. So far, there have been 16 people who want to buy 10 million shares. If they keep lowering the price to $33, there will be more people buying more shares. But according to the Dutch auction underwriting rules, the underwriter will finally set the IPO price at $34. Because at $34, there will be enough investors buying all the 10 million shares that the XYZ company wants to sell. But notice that even the investors, the 2 investors who bid for the price at $36 and the 4 people who bid at $35, the 6 people also finally pay at $34. So eventually, all the bidders pay $34. Green shoe provision. Green shoe provision is related with the price stabilization function of the lead underwriter. The lead underwriter they want to stabilize the price on the day of IPO. So if the price is too high, they want to make it down. If the price is too low, if the price is dropping, they want to make it higher. How do you do that? Well, it's easier to understand when the price is too low. You just use your money, your own money, to buy the shares, so that higher demand will push up the price. But what about the price is too high? So the green shoe provision allows the syndicate to purchase additional 15% of the issue from the issuer. Suppose that you wanted to sell 10 million, say 10 million shares. Now, the green shoe provision allows the syndicate to purchase 11.5 million shares. And the additional 1.5 million shares are used to push down the price. When the price is too high, there is a very high demand, and the price is going up, and you know that the issuer will be unhappy because you are pricing their shares too low. So you use additional shares to push down. You sell the additional shares so that the price will not be that high. There is also a lockup agreement to prevent financial fraud. In the U.S., it's 180 days or half a year. That after the IPO, the insiders, like the executives, like the original shareholders, the owners of the VC or the say GP, the general partner, the talented young man who founded this company, these guys cannot sell their shares right after the IPO. To prevent such situation that these insiders may know something that the other market participants, the investors, do not know. They probably have some very bad news about this company, but they didn't tell the others. So to prevent the situation that they go through the IPO procedure, they sell their stocks to the investors, they ran away, while leaving very bad assets to the potential investors. To protect the whole market, and to protect the potential buyers of the IPO shares, the insiders are not allowed to sell their stocks right away. In other countries, like in China, the lockup period is much longer than 6 months, okay, to prevent the financial fraud happening. The stock price tends to drop when the lockup period expires due to market anticipation that additional shares hitting the streets. Because some people, some founders or co-founders in the company, they just don't want to. Running a company is really, really time-consuming, and the people it can exhaust even very talented people. Some people just say, "Hey, why don't I just sell the stocks to other people and just go somewhere like countryside and build a house and live a happy life." So some people, they want to we say cash out these stocks. So that the market anticipates that there will be more supply of the stocks, so the stock price tends to drop. We also talked about the IPO underpricing, and basically it's about the IPO price is not the IPO price tends to be underpriced a little bit, so that the potential buyers of these financial assets will enjoy price appreciation. Otherwise, if they buy the financial assets and the stock price will not increase, why do they buy the stocks? They buy the stocks to gain money. So that's why when you price, when the underwriters price the IPO stocks, they price it a little bit lower to make sure that the potential buyers will enjoy some profits. And this is average initial returns of the IPO, SEC registered IPOs from 1960 to 2013 in the U.S. And this is from Journal of Applied Corporate Finance, co-author with one co-author is Jay Reeder at the University of Florida, who's very famous, or probably the famous IPO expert. And you can see that the average first day return can be really high, and there are very few cases when the IPO price, the price dropped on the first day of IPO. some stocks go up by even 100%, but most of them go up by 5, 10, 20%. So it's pretty common. The number of offerings vary by month, okay, and by years. During the 1970s, because there was a financial crisis, the oil crisis in the U.S., so the economy wasn't that good. Actually, it was pretty bad. So during the economic boom, there will be more IPOs. When the economy is in recession, people know that the economy is really bad. People don't have money. Investors don't have money. So there are fewer IPOs and less offering. New equity issues and price. The stock prices tend to decline when new equity is issued. Okay. Possible explanations include signaling and managerial information. Why is that? Why is the signal? Why is the bad signal? Because the new equity is issued from whom? From the original owners. And these owners are either GPs or the LPs. They're either the talented founders or the VCs. Why do they want to sell this equity? They are the insiders. They have some insider information that the market doesn't know for sure. And they want to sell the equity. It's unlikely that they're doing charity. It's very likely that this stock the price will not go up in the future. They sense that. Because if the price will go up, why do they sell the valuable asset now? So this is a signaling effect. Maybe the general managerial team has already had a problem. Maybe they have some other problems. It's also signaling about the debt usage. Maybe it's because they have too much debt and they don't have money. So they want to sell some equity for money. Why do they have to sell the equity? Because they can't find other people to loan them money. Maybe they have the financial constraint problem. So maybe the potential sale is signaling that. There was a very minor thing about the issue cost. Okay, when you issue additional, this is called seasoned issuing. Okay, the seasoned issuing is that when after the IPO you issue new stocks. It also has some issuance costs, but this is a minor reason compared to the previous signaling effects. Since the drop in price can be significant and much of the drop can be attributable to negative signals, it is important for the management to understand the signals that are being sent and try to reduce the effect when possible. So that is to say, the management team, if you really want to issue the new equity for some good reason, you must think ahead and you must anticipate that the market will interpret your move as a very bad signal. So you want to do something to reduce this negative effect. There were many issuance costs, like spread. This is issuance cost to the issuing company. The syndication, the underwriters, the investment banks, they will get a spread profit. This is what you have to pay. Legal fees, filing fees, registration fees, a lot of things. And indirect expenses including opportunity costs like management time spent working on issue. The roadshow may last for even a month. So that means you will have a month not being able to work to run this company's operation full time, or even not a little. You have to travel with the underwriter team to to do the marketing for your own company stocks. Abnormal returns. There could be price drop on existing stocks if you issue new stocks. And to make your potential buyers to earn money, you have to make the price under the reasonable equilibrium price a little bit. So this is underpricing. And that's also some loss. And also to stabilize, for your underwriter to stabilize the price, you have to give the green shoe provision. Okay, so you have to sell some additional shares to them. So these are all the issuance costs. Rights offerings. When the company is issuing new equities, the existing shareholders' shares may be diluted. Say this company currently has like 1 million shares, and the market value is 10 million. So each stock price is $10. And this company's value is 10 million, and they want to issue another 1 million shares to other shareholders. Then the existing shareholders' value, the shares, will go down from $10 to $5. So when you want to issue new common stocks offered to new shares, you want to give the existing shareholders a privilege to buy these shares before the other investors can buy. So it allows the current shareholders to avoid the dilution that can occur with a new stock issue. And the rights are given to the shareholders include the specific number of shares that can be purchased, a specific purchase price, and specific time frame. So in this particular time period, the existing shareholders have the right to buy this number of shares at this particular price. This price may be even lower than the market price. The rights themselves are also tradable. So the rights to buy, so as existing shareholders, you have the right to buy the newly issued stocks. These rights can also be packaged as financial contracts, and they can be traded. Okay. Traded over the counter or on a exchange. Dilution is a loss in value for existing shareholders. What can cause a loss in value for the existing shareholders? First, percentage ownership. When the company issues new shares that are being sold to general public without a rights offering, that is, without a privilege for the existing shareholders to buy their new shares, then the new shareholders' share value will go down. Or when the company accepts some negative NPV projects, then its value will go down. The market value will go down because the company is making some stupid decisions and cause the business to lose value. And when the market to book value, that is the market value is equal to the number of outstanding shares times the stock price. The market value divided by the book asset price, the book asset value. When this value is less than 1, that means the market value of this company is less than the claimed total asset value on the book. So when the market to book value is less than 1, that means the market investors do not view this company as much as what its financial statements is claiming. So the existing shareholders' value is under a loss. In this chapter, we talked about many details of the different ways to issue stocks and found to raise the capital. Maybe not the stocks. For example, the crowdfunding is not really about the stocks, but the products. And we also talked about some other like green shoe provisions and Dutch auctions, these details about different ways of the interactions between the underwriters and the issuer companies. And to test this in the final exam, there could be some multiple choice questions, like say how many kinds of methods that an underwriter can help a firm to issue their stocks, and some concepts questions like what is the IPO underpricing, and you should also practice on this rights offering practice, and when the new shares are issued, and then what is the change of the value of those existing shares, and this. Okay, so this chapter is about raising capital, and we have finished it. And thank you for watching. We will see you in hopefully in some other videos. But in this semester, this is the last. This is the last teaching video, and we probably will record other videos if we find other information contents interesting. Thank you very much, and enjoy the rest of the semester, and have a very good. I hope you have a very good result in the final exam.